Okay, good afternoon, ladies and gentlemen, and welcome to the FMC Prep with your host, Tony. Hopefully, you guys can all hear me nice and clearly, and you can also see the slideshow or presentation that I have for you guys on here. But let's get into the gist of everything. Ooh, is my sound working, guys? I don't think I can hear myself. It's a bit strange. Well, you guys can hear me, but for some reason I can't hear myself. Hold on. This is a bit strange. Okay. All right. If you do hear me, then I'm just going to do just a quick check. Hold on. Okay, I've got it now. I had it. I had it on my other sound instead, rather than on the mics. Rather than on the mics sound. Okay, we're all good. I thought something had happened. Didn't want to do a whole stream where somebody might be gaslighting me, saying that they can hear me, but then there's just a whole hour of nothingness. But as long as you guys can hear me, then that's great. And I can hear myself now. All right, so let's get into it. FMC, we've got about 45 or less than 45 minutes. We've got a lot to kind of get through with investment bank views, sentiments, what kind of language to look out for if there was a dovish stance that's taken, and if that could lead to the likelihood of a March rate cut by the Federal Reserve, if that were to occur, although markets are looking around May instead. But let's get into it. So first of all, what is the rate decision? The FOMC, they meet roughly every 6 weeks over a 2-day period. And that's, of course, where they set the policy and federal funds target range. Now, you do have some of the meetings where they also provide the summary of economic projections. That's every other one. So this one's not going to have a summary of economic projections. The next one will. But the statement is usually very short, and looking for clues can be quite difficult when you don't have a lot to work with. So there are two things that we need to be aware of. The reason why it's important is because not only is the rate decision itself important, but also the rate statement as well. And it can cause volatile moves in the markets and affect the wider economy. These rate decisions are very difficult because there's one, the figure itself, two, the statement to kind of weed through and understand what the Fed or what a central bank might be saying, and then to make your trade. So sometimes there may be a feeling of being very reactionary to the market and seeing how it moves before you've kind of passed through what the Federal Reserve has said itself. And then you're kind of feeling that you're not so sure in your movement, in what you've done, then you're kind of hoping, which is a natural thing. The FOMO of seeing maybe a spike up or down, that the Federal Reserve might have said something. So it's difficult in that regard because you have to pass through what's more hawkish or more dovish than expected. And the other reason why it's important is because it can have an influence on other central banks to follow in the rate path as well, in regards to sticking with their strong or their very tight monetary policy or restrictive monetary policy, or going the other direction and starting to loosen up themselves, which could then drop a hint for other central banks around the world to then follow in their suit in that same vein as well. We've seen that with some of the central banks already. maybe not entirely linking themselves to how the Federal Reserve is acting, but we have seen a shift from the ECB, also the Bank of England in their rate statements. What, to a degree, not an entire move towards a dovish point, still being hawkish, but there is that sense of that pivot that's going on collectively together, albeit it may not be exactly at the same time as the markets may want to. They may want it to happen. All right, so how does it affect the markets? Very simple. With the currency, if for whatever reason the central bank raises rates or is more hawkish than expected, then that provides a bullish scenario for the currency, in this case the dollar, because it means the central bank is still in their tightening phase. They're not really ready to move or pivot towards an easing phase or a dovish stance, or more dovish stance than they may have been in the past, which could then lead to markets repricing their expectations of what the central bank will do in the future. And the same goes for the stock market. If you, in regards to the repricing of what the central bank will do, but the market reaction would be if the central bank is more hawkish in their statement, or if the figure is more hawkish, i.e., let's say the forecast is for no change, but they do raise rates today for whatever reason, then that will lead to the stock markets seeing a more bearish reaction. And as said earlier on, there would be a lot more repricing that would then occur of what the Fed's target for their rate path would then be in 2024. They probably could push out a rate cut further into the future, maybe even towards the end of the year, if the Federal Reserve has decided to surprise the markets, go completely against sentiment and hike interest rates today. Not the scenario, just so everyone's aware, just a hypothetical thing. You've got to be able to think of all the different things that could happen. Expect the worst and be prepared, or expect the best thing and be prepared if that's where you're going. If you're keeping an eye on the dollar rather than the stock indexes. For the bond market, if you do get a more dovish than expected central bank, bond yields will likely see a bearish reaction, because that means that the central bank is on an easing phase. It means that the equities then become more attractive in that regard. So there is a push away from buying into or investing into bonds, because the yields will also go lower as well, as participants move their money from the bond market into the more lucrative area of the stock market instead. So what would happen to the bond price? Well, the bond price would then, if bond prices go lower, bond prices go higher in anticipation of lower rates that would come about within the US. So where is the economy at the moment? Of course, we had today's data with the employment change. The employment costs data, which came in slightly lower than expected at 9%. But let's go through some of the other points too. So GDP fourth quarter at 3.3% compared to 5.2%. We also had inflation at 3.4% compared to 3.1%. Core inflation, CPI, at 3.9% compared to 4%. PC price index was unchanged at 2.6%. Core PC at 2.9% compared to 3.2%. Consumer spending at 0.7% compared to 0.2%. Non-farm, which we have this Friday, and I'll also be doing a live stream on that as well, was at 216K compared to 173K. ISM manufacturing PMI, which is later on in the week as well, at 47.4 compared to 46.7. ISM services PMI was at 50.6 compared to 52.7. UMich sentiment at 78.7 compared to 69.7. The 1 year inflation expectations were at 2.9% compared to 3.1. 5-year 2.8 compared to 2.9. These two figures do jump around a lot between the 2.9 to 3% or 3% region or around that. But so there is some choppiness in what consumers are expecting inflation to be. But still quite key for the Federal Reserve to understand what are consumers' thoughts on where inflation is going to be, because then that could mold their spending patterns too, as well, if they for consumers, because it's not a definitive thing that they may decide to cut back on their spending. They may feel that if inflation is going to be lower in a year's time, that they may be able to afford to buy more than what they're currently doing at the moment. Employment cost, as I said, was at 0.9% compared to 1%. And then the previous FOMC summary, which was so the data was the last FOMC on December 13th. So summary of that, they said that they will continue to assess additional information and its implications for monetary policy. Recent indicators suggest that growth of economic activity has slowed from its strong pace in the third quarter. Job gains have moderated since earlier in the year, but remain strong, and the unemployment rate has remained low. And then finally, the other key point was that they said inflation has eased over the past year, but remains elevated. Then the Fed minutes summary from the 3rd of January. So the minutes didn't provide direct clues about when rate cuts might start, but they reflected on a growing sense that inflation is under control and growing concern about the risks that overly restrictive monetary policy could pose a risk to the economy. So what the minutes actually did is, well, they shed little light, as said, on when rate cuts might start, but participants noted an unusually elevated degree of uncertainty about the economic outlook, with further rate increases still possible. So that change in language, of that there is an unusually elevated degree of uncertainty at the December meeting, shows that there is a pivot in thinking towards more of a dovish stance, rather than being cemented in their thought that the economy, that the economic outlook was still okay. So now it's now been driven to the uncertainty side, and that means that the pivot is more likely as the Fed muddles through their thoughts as to should rates go higher or should they continue to stay where they are, or do we need to pivot sooner to then be sure that the economy doesn't go into a recession if we keep rates too high, and when does that happen? So Fed member comments on January 19th, you had comments from Fed's Daily saying that it would be scarring to ease too quickly and not reach 2% goal. Any early signs that the labor market could falter could also trigger policy adjustment. Goolsbee said that goods price inflation is back to normal levels, and there is surprising progress on services inflation too, which is something that's going to be, I believe, a highlight, or could be a highlight for this rate statement as well, if they do mention services inflation, which rarely would they kind of talk about what else is going on within the economy besides jobs and where inflation is, unless it becomes the key focus, or unless there is something else that becomes a focus. For instance, if the Federal Reserve in the past had focused on housing data and how housing had performed during the last recession of between 07 and 09. Fed's Bostic said that I am open to start cutting rates before July if there is convincing evidence that inflation is slowing faster than I anticipate. Fed's Waller on January 16th said that his view is consistent with Fed policymaker projections for 3 25 base point rate cuts in 2024, and that he's more confident that the Fed is within striking distance of achieving sustainable 2% inflation. So off of the back of that comment from Fed's Waller, being being the first member to state how many rate cuts that they see, and also holding the belief that inflation is near the 2% inflation goal in their eyes. That led to US short-term interest rate futures implying less than 60% chance of a Fed rate cut in March, versus more than 70% chance seen before Fed's Waller's speech. So the implication is, if the markets have been pricing in more rate cuts from the Federal Reserve, but then you have a central bank member like Waller who then says he expects 325 basis point rate cuts, which is way less than what the markets were expecting, which I believe was about 100 basis points worth of cuts in 2024. Then you start to see those shifts in sentiment and repricing from the markets. He also said that a strong economy gives the Fed flexibility to move methodically on cuts, and if we think we need to do more, if we think we need to move rates down faster, then we can. And then December 13th, he had Fed's Powell, who said that you need to reduce restriction on the economy well before 2%. And policymakers are thinking that we have done enough, but we are not fully confident in that view yet. So again, from then, we're opening up the conversation of when a pivot could happen sooner rather than later. Potentially March, but it depends on what the Fed says today, and particularly, and especially what Powell says today, actually, rather than the statement itself. The statement itself wouldn't really tell you that the central bank is going to start cutting rates at this time. It will imply it through its language in a very vague way. So a lot of traders might blow over the small bits of detail. Again, another reason why it makes it hard to try and trade a central bank rate decision, especially the Fed, if there isn't anything concrete or something that you can really dig your teeth into. Okay, so this was the CME Fed Watch for the looking at the expectations then for the March meeting back on the 29th of Jan. So you can see here the expectation for the rate to go to see the first rate cut in March by 25 basis points sat at 47.7%. So just shy of so more or less a 50-50 scenario of markets expecting a rate cut in March. And a lot of the data so far hasn't really oh yeah, we can see an updated version. Well, this is yeah. I was just talking about. I mean, it's more or less the same. It's going to do that. It's going to chop between around the 50%. So it is about 50-50. Thank you very much. I mean, yeah. So it depends. I mean, today we had the employment cost data, and that would have kind of helped those bets for a March rate hike. But again, it's kind of wait and see to see what the Fed's Powell does say at his meetings today to kind of confirm more of that bias towards a March rate cut. Okay, so let's keep going. So investment bank views then. It's quite heavy. I'll try and get through it in a nice and easy way. So Wells Fargo, post the last Fed rate decision, they said that they think the markets are still priced for a too optimistic outcome regarding future rate cuts, and the disinflation base effect wears off. They think that it will, if that disinflation base effect wears off, they think that it will prove difficult for inflation to move quickly towards the Fed's 2% goal for inflation. They add that given our expectation of only 2 rate cuts in 2024 following an economic slowdown in the first half of 2024, we continue to position our portfolios defensively. Bank of America, they said that they believe the rate guidance needs to shift again. So this is recent comments from them at the end of last week. So they said they believe policy rate guidance needs to shift again, and they feel the current upside bias in the statement remains untenable, i.e. talking about leaving the option open for a rate hike in if needed in the future. So they said that if the Fed follows the evolution of guidance that are used during 2006 and 2007, it could change the language in the statement to read, in determining any future policy rate adjustments that may be appropriate to return inflation to 2% over time, which could then suggest, they themselves say that could suggest both rate hike or easing. But in this current scenario, they feel that it could signal some easing bias instead. So Citi weighing in on with their own similar comment to Bank of America, they say that they believe the language change from additional policy firming with a more neutral statement like appropriate policy settings could be seen as more dovish. So this is why it's important to be able to understand the difference in language with what the central bank is saying, and it can go whoosh, right over a lot of people's heads. So this is what a couple of the investment banks are talking about as to what could show the shift that the central bank is likely to cut rates. Now they haven't said that they're expecting the Fed to do it in March, but it's just more like a switch for the Federal Reserve to get their head in the game and say, right, now we can pivot and we'll do it at this time. CIBC, they feel that the Fed is prepared to give the economy what it needs, but solid growth suggests it's hardly desperate for a rate cut just yet. Goldman Sachs, they expect a rate cut in March and 5 in total this year. So they said earlier on in the week that markets are pricing a near 50% chance of a Fed cut in March. The FOMC will likely aim to keep a March cut on the table without sending a decisive signal by removing the outdated hiking bias from a statement and noting that future policy changes will depend on upcoming inflation and other data. So what we need to take away from this is that the change in language going from additional policy firming to appropriate policy settings could be the likely change that would come out of this statement from the Federal Reserve if they're leaning towards if they're pivoting. But if they do decide to keep that in, it could then muddle market expectations and lead to speculation that the Federal Reserve isn't done quite yet, and they might keep their rates higher for longer, and that then in turn from that speculation could then push out the potential rate hike from March or May to maybe even later instead. So is everyone clear on that so far, on what I've said? Which line is that again, please? So the line from what Citi have said, that if the Citi, they believe that the language change from additional policy firming to a more neutral statement like appropriate policy settings could be seen as more dovish. Hopefully that kind of clarifies that point there for you. I mean, it's how the markets go. I mean, you get a little bit. If the Fed throws a bit of meat out into the yard, everyone's gonna lap it up and try and take their piece from it, even though it might not be the right cut of meat yet. It's a good analogy. Maybe it is. Anyway, so far, if you've enjoyed this content, if you found it useful, then don't forget to give the video a like, subscribe to the channel, get the word out there, share it with your fellow traders and friends, and let them in on, let them know about the information that I'm spewing here for you guys. All right, so let's carry on then. So market pricing. So we had on January 5th, Fed swaps reprice odds to 70% chance of a 25 base point hike. It's cut in March. January the 11th, Fed swaps price in less monetary easing 2024 after the inflation data. On January 12th, they priced in more monetary easing in 2024 after a weaker PPI. 17th, Fed swaps trim odds of a March interest rate cut to about 50%. And January 19th, Fed swaps trimmed odds of a March interest rate cut to nearly 40%. So you'll see a lot of this chopping and changing of expectations and repricing, which has added volatility to the markets. Of course, we've had earnings season this week as well, so more of them, particularly with how the US has been doing so far, albeit the earnings we had last night. From big tech stocks, and no mention or talk of AI. So you do have a bit of that volatility that's there as well. But the Fed brings its own kind of volatility during that short period of time. And then maybe, depending on how hawkish or dovish the Fed is, if traders don't blow it to the side, then that sentiment from this meeting could then carry on for quite a while. Okay. And then if we're looking at some of the other points on January 26th, short traders see probability of first rate cut in March at little less than 50%. Rate futures traders continue to see the strongest chance of the first rate cut in May. And then short-term interest rate futures fall after economic data as traders pair bets on Fed rate cuts. Pascal David said, what are the effects though? Okay, so I'll repeat what the effects could be. So the effects of a more hawkish than expected central bank will lead to a more bullish reaction from the dollar and a more bearish reaction from the stock indexes. Bond futures, when we're considering prices, we'll also see a more bearish reaction as bond yields will then go up. And then vice versa, in the simplest way to put it. All right. So this is the last report that we had seen from the last report that we seen the market reaction back then on December 13th. So this is about 10 seconds before the December 13th data had come out. Remember, in this meeting there were the summary of economic projections, which made it easier to kind of trade what the Federal Reserve's expectations are. And in this video, you'll see that. Well, you might not see here actually, maybe, but in this live stream that I was doing, the Fed reversed back to its June FOMC summary of economic projections in regards to where they see the rates in 2024. So I'll play it here, and you also see me that I did have a trade on here as well on the NQ. So the data had come out, the expectation had also, the summary of economic projections had come out too, and that led to a bullish reaction from the stock market off of the back of the summary of economic projections that were released back then. Ooh. I was trying to skip the video here, but probably leave it as it is. So I went on a long position, traded the spike off the back of that, and and just let the position do its thing. In this case, it was simpler to kind of take that decision because of how dovish the summary of economic projections were. This round, you don't have the summary of economic projections to give you an extra bit of information to make it easier for you to trade. So this is something that we've got to be cautious of, is that reading through the statement itself is still going to be key, but then also not to have a FOMO idea of jumping into a trade because you see a big old wick, big old candle that's appeared. It's up to you. Of course, do what you want to do, whatever you're comfortable with. If that's how you like to trade it, fine. But in this case, because of what I had seen from the summary of economic projections and what the Fed had said, then I took my decision. And then, of course, it is what it is, baby. And then you gotta, and then just leave it and see what happens. Okay, so if I kind of skip forward as well, and then we can see how long it kind of lasted for. So they were still, see there on the NQ, they're still trying to push up, and even on the S&P 500, that it had still done quite well for itself, and was still also trying to mimic what the NQ was doing. Kind of skip a bit more, and more or less that is the video that's there. Okay, so let's get out of this then. So what I want to show you guys is the deviations then for the economic release, and go through how big of a move that we had seen last time round. And let me just bring it up. Oh, there we go. Yeah, so let's just go through how big the last market reaction was for the FOMC. Okay, hopefully you can see that there. Here we go. So the last rate decision that we had, we can see that the initial market reaction was bigger than what we had seen the prior time. How can I access that simulation? It wasn't a simulation. It was just my YouTube video that I had, the last live stream that I did, and put it onto the presentation. Yeah, that's what I can say, because that's what it is. So with the S&P 500, as you can see, there was a much stronger reaction than there was the last time around before that, December 13th. So this is the deviations Google Sheet. Let me explain that first. What is all this? How do I make sense of this? What are you trying to show me here? This shows you the Google deviation ranges Google Sheet shows you how strong the markets have reacted, or maybe not as strong as not a strong market reaction to an economic release that has occurred. Okay, so we cover not only interest rates, but also the other bits of data too, like we have coming up this week, non-farm payrolls on the Friday. Tomorrow, we have the Bank of England rate decision to cover as well, and that can provide some decent moves too. So what do these numbers mean? So on the left-hand side here, you have of course, what the forecast figure was and what the actual figure was. Next to that, you have what was the total difference or the deviation. Okay. And then here you have so this initial figure here, these figures here shows you how strong the market reaction was. So this initial figure here, where it says 59 ticks up, or 59 up, shows you that there was an initial 59 tick move towards the upside on the S&P, and that's going this on a 1 minute chart, going to the wick of the candle to show you the entire move. And then here in the black brackets represents the move 10 minutes after the release has occurred, going to the end of the candle. Okay, so here you can see after about 10 minutes of the economic the event, that it was up by 112 ticks, and after about 30 minutes of trading, 30 minutes, the S&P in the blue bracket here was up 132 ticks. So ideally, in this sort of scenario where you see the asset that you're looking at that continues to either move up or down in one direction rather than clawing back, rather than making a reversal, gives you the best sort of scenario within a trading scenario if you're looking to hold onto your position or take further extra trades here and there as the market continues to either go up or down. What is then more confusing or harder to kind of do is when the statement isn't that hawkish or dovish, and the initial market reaction isn't that strong either, and then you start to get a reversal sooner rather than later. Then that means that you're looking for a very you're more or less going to be in and out of your position, and you're not really going to stay in it too long. And if you're kind of late, then it could mean that you may have to go for the reversal instead. If there hasn't been too much of a hawkish, or if there hasn't really been a hawkish or dovish shift between from the Federal Reserve, or if there aren't any surprises that the Fed has presented, then it doesn't really leave you in the position to be able to take a longer trade, or hold on to a longer trade, or jump in and have those mini trades going in one direction. If it starts to reverse, well, I mean, you can take them the other way. But ideally, where the most volatility is where you get a very hawkish or very dovish central bank, and then that provides you with more opportunity rather than kind of kicking you out sooner than what you might want to do. But in another way you can play it is if you don't really get a hawkish dovish Federal Reserve, it is more of a neutral statement. I think, as somebody had said there, neutral data or statement is just dead. Then it's up to you if you want to play it. Just kind of look at the history of how the markets have reacted. On the right hand side here is the sentiment of what was said beforehand, of what led to the sentiment of how the markets had reacted. And then you make up your own mind and do whatever you want to do. So here you can see with the Nasdaq that had a very, probably the strongest reaction since the 14th, or actually, I'm going to go back, since November 2022. Okay, going back, not November, going back in December 2022, when you'd seen 619 ticks down off of the Fed rate decision. Of course, you had the hawkish statement that was provided back then, but over time that kind of dwindled down in the strength. So enough for it to, when I say 400 tick move, I'm referring to the 10-minute move. If we're looking at the initial market reaction, then you're looking back to there, March 2023 for the initial move. So that highlights the importance, or that they highlighted the importance of that economic release. And of course, it was the end of the year as well. So you would have had the liquidity that would have, gone from the rates from the markets to kind of give it a bit of a boost. Okay, so if we're looking at currency pairs, we know that with the pound, it's been in one of the top performing currencies of the year, with the dollar not being in that bracket, and had seen a lot of weakness. But overall, the biggest market reaction within the currency space has been on the dollar yen, consistently, maybe barring a couple of releases here or there. But overall, dollar yen has seen the most consistent move, even as the Bank of Japan talks about the potential for raising rates, but they're still putting it off. They're not really giving any hints, even though the markets might be planning or expecting the central bank to raise rates at their next meeting. So dollar yen had seen the biggest move in the markets currency space wise, If we're looking at the bond futures on the 2-year bond, on the 2-year ZT, we've seen the biggest market reaction. So the shortest rate on the that you can trade for the 2-year had seen the biggest market reaction of 67 ticks towards the upside initially. Had seen a bit of a pullback to about 55 ticks up. But then after 30 minutes, it was up by 80 ticks. So that is something to be aware of. If we're looking at the past reaction from the very dovish statement, the summary of economic projections that was provided by the Federal Reserve. And here, similarly on the 30-year as well on ZB. Bitcoin futures. Bitcoin does whatever Bitcoin wants, but it also did see a positive bullish move towards the upside as well. All right, so I'm going to try my best to read through what the Federal Reserve is saying. So also, if you like access to this here, and you want to be able to see the deviations, Google Sheets deviations for yourself, then thank you very much, 3 minutes. Yes, less than 3 minutes. Then if you want to see the market reactions in live and real time being updated for you, and also see past market reactions, not just FMC, like I said, but we've got the Bank of England tomorrow. We've got non-farm payrolls on Friday. Then you can sign up to the MACROACE mailing list and then have a little look at that there. Now, I'll be sending out an email on Monday. So if you do subscribe today, you will get that link on Monday to be able to see the Goals and Ranges deviations sheet. You won't get it today. Yes, we got a little bit time, not too long. So I'm going to close out of this now, get myself set up. So about 10 seconds before the release, I'm going to go quiet and I'm going to focus on the release and then see how it goes as well. Yeah, there is a bit of a delay. Of course, we have the pro version of FinancialJuice, so I can't give away the pro version of FinancialJuice in live in real time here for you guys. Okay, 1 minute to go. All right. Okay. We'll see how it is. All right. I'm probably going to go quiet now, so I'm going to mute myself, and then let's see what happens, and then I'll jump in afterwards. Okay, so short taken there off of the back of that. Probably see. Okay. So they don't see, key point, they don't see cuts until more confident inflation is nearing 2% goal. So we'll see how another short goes here. Okay, so they're not really, they haven't really reverted to, they're not really showing that pivot towards the rate cut expectations or what other markets are looking at. Okay, so still seeing, we'll see how this position goes, see how long the sentiment lasts. But rates, futures traders keep bets first. Rate futures traders keep bets Fed's first rate cut to come in March. Interesting. More or less, you kind of had the Fed that did kind of push it out there. No, I already shorted before, so just kind of seeing how it kind of goes with this. See how long the sentiment lasts. But I think with TICKSTRIKE, that's going to kick me out there. Okay. All right. Okay. So one good trade, the other one trying to continue with that momentum. TICKSTRIKE showed it was going to go back up. Okay. So other than that, all good in the hood. All right. So I think that's done there for trading. So as I said, initial move down was good. And then second one, second position I took didn't do that well. What's it get? So Fed swap steady, price 140 basis points of easing in 2024. And what else we got? Yeah, so no, so just to reclarify then, didn't get that dovish pivot comment or anything to say that they're ready to cut interest rates, as we'd seen earlier on. If I just bring up the comment again, yeah. Again, the Fed says that they don't see cuts until they're more confident inflation is nearing 2%. What else we got? But they did remove reference to potential additional policy firming, though. So that would help the idea that the Federal Reserve is potentially open to cut rates, but the idea of the March rate cut, I mean, it's still there from what traders, Fed swap traders, or rate futures traders are seeing. So seeing a reversal here on stock indexes. Wow, my brokers call me now to close all my positions. Pascal. Dang. All right. But nothing else from there. Okay, so what do we got here? See on the Dow, 35, 33.5. Okay. So let's have a look at so for tomorrow then. So I said, if you like that stream and if you found that information useful, then don't forget to give the video a thumbs up, subscribe to the channel, get the word out there, and also we have a new promo for you guys for FinancialJuice. So FinancialJuice is a live voice and text service keeping you up to date with what's going on within the markets, what central bank members are saying or have said in the past, and then also keeping you up to date with any geopolitical events that might be occurring, if it is to do with anything that's going on in the Red Sea with the Yemen rebel Houthis, the Yemen rebel Houthis. That's all here in one place on FinancialJuice. So you have your live voice feed here, where I've just clicked the button, and in the center you have your text feed as well of all the headlines that come through, all live and in real time as well. And then on the left hand side here you have your economic calendar of all the upcoming economic releases and data that would be coming out for the week ahead. At the top you have your need to know market risk to let you know of what to be aware of from the headlines, or if there has been an event that has occurred that has moved markets or could potentially move markets from a comment that has come out to be aware of. All of that is in one place, live and in real time on FinancialJuice. Okay, so we have the new promo that we have, New Year 92. So you can get 92% off of FinancialJuice following using this promo code that I'll put in the chat here now. That's there. Okay. Oh, that's the link to go to FinancialJuice. And sorry, this is a promo code for you. There you are. So with the promo code, as said, New Year 92%, New Year 92, yeah, 92% off FinancialJuice for subscription. And the link that I posted there for you guys is a link to the light version of FinancialJuice, which has a delay. There are adverts that do play. So to get the best or the most out of FinancialJuice is to use the live real-time voice and text service, so you can manage your trades or capitalize on potential trades that occur, that could occur or be presented from themselves, all in one place. Now, if you do decide to subscribe and take on a subscription, first make sure that you have an account on FinancialJuice, that you have your login info, and that you've verified your email, that you verified your account through your email. Once you've verified your account through your email, then go to FinancialJuice, log out, and then log back in, and then you should get the pro version of FinancialJuice. If you're not ready to go pro, then of course you still have the live version of FinancialJuice, which will, albeit it being delayed, it's still it can still be used as a way to help you get used to how to use a live voice and text service. With, of course, in this case, you would have a delay. But have a little play with it, get more comfortable, and then when you're ready, and then you can choose your subscription that you want to choose. Okay, so as said, that is there for you to have a little look. How fast is the data? It's fast. It's pretty fast. It's it's lickety split. All right. So that's FinancialJuice, and then we also, of course, have a TICKSTRIKE here. As a TICKSTRIKE, if you've never come across what TICKSTRIKE is, it allows you to listen into and see how strong the buying and selling momentum is, audibly and visually. And when I say audibly and visually, I mean this ticker box here. So let's just grab up the S&P here. Okay. So this represents how strong the buying or selling momentum is, in a way, in another way to explain it. And this positive number, this tick box shows you a number, and a plus number shows you the buying momentum, and vice versa. Now, the numbers, what they mean is, number one is the most sensitive to market reactions. So then when there's a little bit of buying or selling momentum that occurs, then TICKSTRIKE will pop off and give you an alert there. And then when you take it all the way to 15, or start going all the way to 15, 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that occurs, then TICKSTRIKE will go off and give you a visual and audio alert. Of course, you can kind of chop and change if you just want the visual, or if you just want the audio, you can change the color, whatever suits you. You can do that with TICKSTRIKE, and you can chop and change the sensitivity of a TICKSTRIKE to suit your trading needs. And the other cool thing about it is we have this lightning bolt symbol. The lightning bolt, what it represents is an uber sensitive TICKSTRIKE. So remember I said level 1 is the most sensitive to market reactions. The lightning bolt takes you 15 levels below 1. So then it becomes uber sensitive to market reactions. And you can see all the little bits of buying and selling that goes on to minute details, and however sensitive you want it to be using the lightning bolt. And of course, you can still chop and change that. So going from minus 15 to 15, which is more or less the normal level 1, or the non-lightning bolt level 1. Okay. So if you're scalping the markets and you're looking to capitalize on those little bits of potential trades that you could see happening and occurring, and again, it's another tool for you to use and utilize in your trading. Of course, if you're not ready, you still have the free version of TICKSTRIKE that's on the FinancialJuice site. It is restricted in regards to the sensitivity, and you can only look at the four different assets here. You can only look at the S&P 500, Euro Dollar, oil, and Bitcoin. But again, if you want to get used to the idea of how to use TICKSTRIKE, then again here you can have the sound playing for TICKSTRIKE here, and then utilize it however you want to utilize it. And then when you're ready, then you can have a look at this link here to sign up to TICKSTRIKE. All right. So that is the live stream for today. Let me grab the live stream for tomorrow with the Bank of England interest rate decision. We're up here. Where are we? All right, so tomorrow you can join me live at 6:30 a.m. Eastern Time for the Bank of England rate decision. That is at 7 a.m. Eastern Time. Okay, so let me pop that in here, find my way back to you guys, and here I am. And I'm back here. Cool. So that's the live stream for tomorrow for the Bank of England interest rate decision. So don't forget, if you enjoyed the video, don't forget to give it a like, share the channel, subscribe to the channel, share the video, get the word out there for you guys to be able to listen to and understand macroeconomic data on how to interpret it. And yeah, other than that, have a great evening or an afternoon, and I'll see you guys tomorrow in the morning, bright and early at 6:30 a.m. Eastern Time.